When utilizing financing for your project needs, don't forget there's a price that you want to borrow for the project, and then there's also the price you're going to pay to borrow the money for the length of time you need to borrow it, the interest rate, and the amount. Most homeowners only plan for the amount they need, and then they fall short when it gets toward the end of the project and realize that the cost of financing is eating up some of their budget. Let's talk about the financing so you can understand what to plan for. If you're going to borrow money to complete a project, make sure it's based on some kind of detailed scope. Worst thing you can do is ask to borrow money and find out that what you've asked for is not enough to complete your project. It's fine to ask your lender for a ballpark to get an idea of what kind of amount you'll be able to get. But after you get a ballpark range of what you'll be able to borrow, make sure before you pull the trigger that you've got a detailed scope from your contractor to understand every nook and cranny and make sure there's nothing left out and no surprises when you ask for the money to borrow. If you don't figure out how much your project is going to cost now, you will find out how much it's going to cost when you run out of money and need to ask for more money or figure out how much you need to save up to complete the project. So go ahead and do your best to finish the project budget before you ask for money. Make sure that you understand the scope, the materials, the timeline that you have to borrow this money and what it's going to cost in that amount of time. And make sure you also have some contingency money in there because there's going to be surprises. It's not if, it's when. So make sure you have all that accounted for before you sign papers to borrow money. If you want to finance safely, you need to understand your total project budget, you need to understand your contingency, and you need to understand how long you're going to need this money. And make sure you give yourself a little buffer because if you're going to go underwater, if the project is 1 month over schedule, you're playing too tight. So give yourself a little breathing room. As far as contingency, a good rule of thumb is about 10 to 20%, depending on what type of project you're doing, because you never know what's behind the walls, in the ceilings, or underground. If you truly can't afford the contingency or a little timeline buffer, then I don't believe you should start the project. Wait, figure something out, because the worst thing you want to do is stop and owe money when you haven't finished your project and can't either enjoy it or get to a place where you can refinance and pay back the money. Let's talk about the common options. Of course, you have cash. This is a great option if you have plenty to spare, or it's just an important project for you. But of course, there's no interest with cash. There's no strings attached. There's no personal financial statements, none of that. So that's your best option. Second would be a home equity line of credit, otherwise known as a HELOC, or a home equity loan, or otherwise known as a HELoan. These are going to be your most affordable interest rates, pulling off of the existing equity you have in your home. And so the bank sees these as very stable lending opportunities because it's backed by the equity in your home. If you don't have a lot of equity in your home, you may look at a personal loan, which can come quickly, which can be beneficial, but you will face higher interest rates typically. Outside of these options, you're going to be looking at higher interest loans, more aggressive lending, and it's a little bit more dangerous to play with. So if you don't know what you're doing, I wouldn't suggest just popping a loan at a 30% interest rate unless you have a guaranteed plan. Like anything, there is no one size fits all for financing, so you want to take into consideration your equity, your cash flow, your timeline, and what the project is for. Take all these things into consideration before you decide on your financing. Before you sign anything, make sure you're checking the math. A lower payment can also mean it's a longer term than some of the other competitors are offering you. It also can mean you're just paying more over time. Check for prepayment penalties. Check for if you needed to borrow more money, is there anything left? And consider all the circumstances before you decide on where to get your financing. You've just finished your project. You're wondering, what do I do now? Well, you can continue to make the payments that you've been making on your financing and leave as is until it's paid off. Or you might consider something like a cash out refi, where you would now get the home reappraised now that you've added the addition or the ADU or remodeled the kitchen or the bathrooms, and your home will likely appraise for higher. And then you can do a cash out refinance with this new forced equity that you've made on the property and then take that money on the cash out, pay off that loan, have a lower interest rate on a second mortgage or something similar to that. So that's an option as well. Pay off the first financing to lock in a lower interest loan on that money. If this episode brought you any value, like, subscribe, and drop a comment down below. I'd love to hear about your experience with financing and look forward to hearing from you.